Good morning, everybody. Thank you for joining the ACA Small Business Bootcamp and Resource Collective for this Tuesday morning, September 1st. I'm Robert Theobald, Small Business Ombudsman and Vice President of Small Business Services here at the Arizona Commerce Authority. I want to thank you for joining us today. We want to start by thanking all of our community partners for their help and support in the bootcamp series. We could not provide this without their dedication, expertise, and support. The Small Business Bootcamp is designed to help small businesses work through the COVID crisis and return stronger than ever. It's a statewide initiative supported by those community partners. And it is a program we're going to continue to run through September and possibly into October. And we have been running it for many months up until now. So all those previous sessions of the boot camp, we started in April, and we've recorded all those previous sessions. They can be found on our website, the Small Business Bootcamp website. Same website you use to register for this session. So if you scroll down, you can find the archived pages and by week and have all those previous sessions. You can go back and review them and the material that's in them, along with the slide decks that were provided during those sessions and other materials. Additionally, on that website is a link to the Small Business Bootcamp Resource Collective. And the Resource Collective is a series of guides and tools provided by our community partners to help small businesses through this time. This is just a sample list of some of those items that are in the Resource Collective, but they have guides for retail, for restaurants, cosmetologists, construction workers, safety, manufacturing, online resources for families to stay healthy and active. Lots of resources to help support you as a business owner during this time. So jumping into this week, we have two great sessions planned for this week. Today we have the ABCs of business, revenue versus profit. We're excited to have that. We have Steve Engelhardt from SCORE presenting that. And then this Thursday, just a reminder, we switched from Tuesday, Friday to Tuesday, Thursday. So no one has to try to jump on a session before the Labor Day weekend. But we have a Thursday morning session, is how to attract and retain customers during COVID-19. And that is brought to us by Elite Entrepreneurs. They're a great business that helps small businesses grow to medium-sized businesses. So some quick updates. Just received an announcement that the LISC Small Business Relief Grant version 6 is out, and the application process goes through September 7th. So there's a small window to apply for that Small Business Relief Grant. It's a nationwide small business relief grant, so there's some competitive nature in that piece, but it is now available. The Maricopa County Small Business Grant Phase 2 is still open. And then for those looking for loans to help support their business, the Economic Injury Disaster Loan Program is still available. Just a quick reminder for the Arizona Together.org website, the state's COVID-19 information and resource website. And then our COVID-19 business resources website has a plethora of information. If you look under the financial resources there, you can find things from banking connections, from lenders, grants, loans, other resources. There's some information on there for some programs from Yuma to Casa Grande to Tucson. We've got all the different links in that website as well to help navigate through many of those programs. Additionally, the ACA has many programs for small businesses. We have our small business services, and we can help with navigating the SBA, Small Business Development Centers, SCORE, local banking contacts, etc. Our workforce division as well can help support business owners as they look to hire employees or train and upskill their employees. They have many programs for training, including some federal funding for different training programs. And then we also have our Arizona MEP, Manufacturing Extension Partnership, and they're a program to help small to medium-sized manufacturers grow and strengthen their operations. One tool we have, if you're looking, that ties into the ABCs of of your business is our small business checklist. If you're looking to start a business or expand your business into new product lines or new industries, the small business checklist can help you as an online resource to identify the planning development needs for those industries or that business, license, registration, compliance, things as well. So it's a great resource. You can find that at azcommerce.com/smallbiz. So today we have Steve Engelhart. Steve is a certified SCORE mentor. He's also the current chapter president for SCORE Phoenix chapter, and we're excited to have him with us. So Steve, we are going to go ahead and turn the time over to you for your presentation.
Okay, I'll get back to sharing my screen. Just a second. There we go.
Yep.
Okay, so this is managing by the numbers. On this first slide, it says, if you don't know your numbers, you don't know your business. Why is you in the great big red letters? Because you need to know your numbers, not your accountant, not your spouse who does the books. If you're running a business, you need to know your numbers. So SCORE is part of the U.S. Small Business Administration. We're a resource partner. We provide free mentoring to businesses. We do a lot of workshops just like this. We provide a lot of resources to the community on our website. We're there to help you, and at no cost for the mentoring. If you don't know how to read your numbers, go find a SCORE mentor. Get a SCORE mentoring appointment. We'll teach you how to do it. It's not as scary as you think it is, but it's highly necessary. So let's talk about these folks, because I guarantee you they know their numbers. The guy on the left is Tillman Fertitta. Tillman owns the slide says 46 restaurant concepts. He just bought another one. He owns 47 restaurant concepts. That's not 47 restaurants. That's concepts. So that's all the Bubba Gumps, all the Mortons. He owns these 47 chains of restaurants. He owns the Golden Nugget Hotel chains. He owns the Houston Rockets in the NBA. He just built a 5-star hotel in Houston. The guy's amazing. And he used to have a show on TV called The $1 Billion Buyer. And one day I was watching it, and he got off of his jet on the runway, and he was talking to a guy out there. And he looked him in the eye, and he said, I know the numbers of every one of my businesses. And you knew he meant it. On the left, or on the right, is Marcus Lemonis. That's a show that's still running called The Profit. He owns RV World, Camping World. He also bought Gander Sports. They're renaming the whole thing Gander. But he owns 146 businesses that he has bought into. He likes to go in and buy distressed businesses and turn them around. He knows his numbers. Of course, in the middle, the sharks. Everybody knows who they are. I guarantee you, every one of those people know exactly what their numbers are in every single one of their businesses. The one that probably is involved with the most businesses is Lori. And if you listen to her, you have no doubt that she knows every single number. You need to know your numbers in your business. When somebody comes in to see me and I say, what's your revenue? And they say, I don't know. I think last year, maybe we did around $500,000. Well, what was your profit? Oh, maybe last year, I don't know, maybe we did about 60,000. That's not the answer I want to hear, and that's not the answer you should be happy with as a business person. You need to know those numbers. That's your life. So with business, it's all about profit. If it's not about profit, just stay home. Even a nonprofit business needs to make a profit. You've got to exceed your expenses. So the basic formula for years and years and years, forever, has been revenue minus expense equals profit. If you want more profit, increase revenue and hold expenses, or hold revenue and decrease expenses. But either way, it's about profit. It's not about revenue. And that's the point I'm going to hammer on this all throughout this presentation, is that you're in business for a profit. You're not there to make revenue. You're there to make a profit. One of the ways you do that is by controlling expense. So on the left is just what I just said. For nearly forever, it's always been revenue minus expense equals profit. There's a new book out by a guy named Mark Spiskowski. It's called Profit First. And he's arguing that that formula is wrong. He's saying you should figure it revenue minus profit equals expense. There is a massive difference in thinking when you do that. It promotes and forces budgeting. It promotes and forces attention to expense. It promotes paying yourself first. So it is very, very important to start thinking that way. Now, the revenue minus profit equals expense model is a tougher model to operate, but you at least need to start working on understanding the difference between revenue and profit. Revenue and profit are not the same thing. So I'm going to start dropping in some little secrets of success I've learned over the years. When I first started selling, I was selling computers. I was a little bit older than the rest of the sales force because I'd been in the service and done some other things. And so the company I was with, the three big computer companies at the time were IBM, Burroughs, and NCR. They tended to hire a lot of young guys out of college. And unfortunately, it was mostly guys. Very few women were in it at the time. And a lot of the older salesmen didn't want to have anything to do with the young guys at all. I was a little bit older, so they treated me a little bit differently. And in '73, there was a little recession. And one day, a bunch of the salesmen were sitting around the office, the young guys, complaining about how they couldn't sell anything because of the recession. And one of the older guys came by and tapped me on the shoulder and said, "Let's go to lunch." And when we went to lunch, he grabbed a cocktail napkin and he drew this. He said, "Steve, the green bar is revenue, the red bar is expense. What's the difference between those two?" I said, "It's profit." He said, "Right. What do people use profit for? They use it to hire new employees. They use it to grow their business. They use it to buy new equipment. That's what they're buying their computers with. They're buying it with profit." When things get bad like they are right now, and they are currently right now, we're experiencing, revenue is down, expense is up, the profit goes away. That means they're going to quit buying. They're going to quit buying those computers we're selling. He said, "You need to change your sales pitch." He said, "Before you were going out and taking advantage of the profit. Now you need to go out and show them, say, 'Mr. Businessman, I'm going to show you how by putting in a computer, you can reduce your expenses and get your profit back.'" Most businesses think the way we want to get more profit is to get more revenue. Not necessarily. Reducing expenses gets the same result. Control your expenses. So I have been fortunate to either, working for a consulting company or mentoring, I've talked to literally thousands of businesses. I think I'm close to 5,000. No one has ever asked me, "Steve, how do I reduce expenses?" Not a single soul has ever asked me, "How do I get more profit?" Please be the first to ask. Everybody that comes in, 100% so far have said, "Steve, how do I get more revenue?" Ask me about profit or expense sometime. I want to talk about that. So expense control. Your profit may be found in your expenses. That's what I'm talking about. So should you have more space or a second shift? So let's say all of a sudden your business doubles. Most businessmen's thinking is, my business doubled, I need twice as much space. Well, do you? Or do you just need to go to a second shift if you're manufacturing? Because if you go to a second shift, your rent was already covered by the first shift. Frequently, your utilities aren't going to increase that much. The machines you've been using all day long are still sitting there at night with nothing to do. Frequently, a second shift is just a matter of bringing on more employees, which means your total product cost is going to drop like a rock. So can you use more space, or is it better to have a second shift? Priority boxes, weigh and calculate. There's a business out in Gilbert that does a tremendous amount of shipping. They don't ship a single box that doesn't go across a special scale that weighs it and tells them if UPS, FedEx, or the post office will be the cheapest. They don't just say, oh, there's a pile of boxes, UPS, come get them. There's a pile of boxes, post office, come get them. They weigh every box and they pick the most reasonable service. It doesn't cost them that much. They got to weigh them anyhow. So weigh and calculate. Calculate a route as opposed to being a star salesman. A star salesman, this is usually when I have a whiteboard. It's easy to talk about being a star salesman. But think of a 5-pointed star and going to the top, then to the bottom, then back to the side. You go all over the place. That's being a star salesman. It's not a good thing. You want a route that makes sense, takes the least amount of time and mileage possible. That is very easy to do now if you're doing deliveries, if you've got GPS. You can put in all your addresses and say, give me the shortest, easiest route. And it'll do it. Instead of just driving around aimlessly, thinking you've got it right. Can you take advantage of utility incentives? So I was with the company, and one day I walked in the CFO's office, and I had some unusual powers for a sales manager. The president kind of let me do what I wanted, and I've looked at the lights in the building. We had fluorescent lights like everybody did, but I knew Colorado Public Service was running a special program to replace lights and ballasts with more efficient ones. They would pay for half the cost. We could get a grant for a third of the cost. And we only had to pay the little bit that was left over. But it would cut our utility bill in half. So I jumped on the program. The CFO yelled at me for spending money. But then when the utility bill came in the next month for half as much as it had been, then he went to the president's office and took credit for it. I live in Sun Lakes, the great big retirement community down south of Chandler. The northern half of Sun Lakes, that is called Iron Oaks. And it's a $20 million business with 200 employees. I'm on the finance committee. We just talked to SRP about our rates. They reclassified us. They have different classifications for electricity. They reclassified us. It's going to cut our utility bill $40,000 in a year. All we did was call them up and they reclassified us. What can you do in your business? They have peak rate billing. Are you running your most expensive electrical machines at a time when you're getting peak rates? Could you run those machines later? You need to think about that. Get your utility representative in. He'll help you cut costs. Push credit card processing costs to customers. I don't know what the average age is out there, people that are listening to me right now. But enough of you will remember there was a time when every time you got a bill from an insurance company or a utility or somebody else, the envelope was postage paid. They paid the postage. All of a sudden, they quit doing that. They start sending blank envelopes. And guess what? Everybody started putting stamps on there. They didn't have to pay for postage anymore. They pushed their postage costs off onto the customers. Can you do that with your credit card costs? All of you know now, if you go into a furniture store, and let's say you're going to buy a living room's worth of furniture, if you say, if I pay cash, what discount will you give me? They will always give you a discount based on not having to run your credit card. So is there a way you can push your credit card costs off onto your customer? Let's talk about unemployment tax. This is one of the things very few employers know or understand, and I mean very few. If you're a brand new business in Arizona, you can be taxed as little as 0.5% of your payroll for unemployment tax, up to 7.5%. Unemployment tax is a tax that's paid only by the employer. The employee never pays into it. People who say, I paid into unemployment all my life, I deserve it, are wrong. They didn't pay a nickel into it. Employers pay unemployment through an employment tax, period. It's 0.5 to 7.5%, depending on the state feels what your experience rating is. So in times like these, when times are tough, if you have to let people go, if you let them go and have to lay them off, that's one thing. But if you have somebody that's a performance problem, they've always been a performance problem, don't lay them off. Take the proper steps to fire them. Give them a verbal warning, give them a written warning with a performance improvement plan, and tell them that if they don't improve, they can be discharged. And then discharge them, and you won't pay unemployment. When you pay unemployment, your unemployment tax is going to go up. Also, when you get the reports from the state on what your unemployment tax is, look at them closely. The states are wrong 17% of the time on those reports. You'll see that they're supposed to be paying out 26 weeks of unemployment. You'll notice they've paid out 52 weeks. You can protest that. So look closely at what you're doing with unemployment. Most people think, oh, it's a tax, I just pay taxes. No, it's the only tax you pay that's controllable. It's a controllable tax. If you want to learn more about it, make an appointment with me because I'm very good at it. Get all your accounts receivable and accounts payable online. You're doing it at home. You're not writing checks at home. Why are you doing it in your business? So constantly review your expense list and look for savings. So every expense dollar saved becomes a profit dollar. If you save an expense dollar, it drops straight to the bottom line. So what's your return on your invested dollar? This is all about opportunity costs. If you've got $100 invested in your business, or if you took that same $100 and invested in the stock market, what would it make? You have other opportunity costs for your $100. So the rule of thumb for years was you should be making 10% on your invested dollar. That's your opportunity cost. Because most people had trouble making 10% in the market. So if you can make 10% in your business, that's what people were looking for. That was the rule of thumb. Today's economy should be 20%. Now, prior to the pandemic, that 20% might have been close because it wasn't too hard. If you actively managed your portfolio, it wasn't too hard to have double-digit returns, which means you need to be getting that out of your business. Or why do you have your money invested in your business? And in your industry, what should the return be? Do you even know what your return is on your dollar? Do you know what you're making? Do you know what your return is? It can be calculated. So that $500 desk, what would that cost you? You're walking through Staples, you see a $500 desk, and you're thinking, you know, that looks pretty good. I'm kind of working on a door that's laid across two filing cabinets. I wouldn't mind having a desk. Well, what's the desk actually going to cost? Well, on a sale, on your revenue after expenses, if you make 10%, then that $500 desk, to get $500 to spend on that desk, you need to have revenue of $5,000. So it costs you $5,000 in sales to get a $500 desk. Do you understand what I'm saying? If you have a 10% return off your investment, that 10% for the desk takes $5,000 to buy a $500 desk. Sometimes when you start thinking that way, you start thinking differently about your purchasing. What does that faster molding machine cost? So if you got a molding machine that puts out 100 items an hour, there's a faster one that can put out 250. Well, that's great. Do you need it for capacity? Are you selling that much more? Or do you need to get those hours back from that employee so you can use that employee elsewhere? What are the costs there? Do the costs balance out the cost of the machine? What if a productivity increase is enough to shift a bank deposit? This is pretty arcane, but I saw it happen once. With a system I put in at Colorado Public Service. We shifted their bank deposit from 2 in the afternoon to 9 in the morning. You think, big deal. Well, when they make their bank deposit 2 in the afternoon in Denver, it can't get to the East Coast in time for overnight deposit. When they can put it in the bank at 9 in the morning, it can go to the East Coast for overnight deposit. And that is a $50 billion company. That meant the $150,000 machine that I sold them to do that paid for itself in 18 hours. That's a good return on investment. What if a GPS added 1 extra sales call a day to your schedule? This worked for me. When GPS came out and I got one, it added an extra sales call a day to my schedule. Any salesman can tell you how much money that would make them if they could get in 1 more sales call a day. It was huge. Oops. Where'd you go here? Okay, what if a switch with a 10,000 transaction life can be replaced with a more expensive one that has a $100,000 transaction life? So I saw this happen. We had a mechanical switch. It cost $1 and it lasted 10,000 transactions. Somebody came in with a magnetic switch. It would last 100,000 transactions, but it cost $10. So it cost 10 times as much, but it would last 10 times as long. Now you think, well, that just kind of balances out, doesn't it? No, it doesn't. Where the difference is, it eliminated 9 service calls. When you eliminate 9 service calls, that's big bucks. So buying that more expensive switch, no brainer. So how many banks and business people don't know how to do this very simple return on investment analysis? Very few, but it's very powerful. Let's talk a little bit of financing and lending. Lines of credit. Every business should have a line of credit. There's business credit for financing things like buildings and equipment, but there are lines of credit. The line of credit is what you use day in and day out to operate your business. For those of you who aren't familiar with it but may know what a home equity loan is, it's like a home equity loan. The bank says, here's a pre-approved pool of money, and we'll give you a checkbook. And when you need some of that money, you write a check, use it, put it back. The biggest mistake you can make is to use it as business credit. So that when you need it, you don't have it. A line of credit is where Christmas is coming up. I need an extra $25,000 worth of inventory. I need that just for 3 months. Write the check, get it, put it back. It's flexible, in and out, in and out. You get to the end of the month, you say, I'm short on payroll. I can't make payroll this week, but I've got some invoices coming in next week, so I know I can. You can use your line of credit to make the payroll, but not if you've used it up. So line of credit, flexible loan that's there when you need it. Business credit for things that are more permanent. Some other types of credit are personal. You're loaning the business the money. It's coming from a bank, or it's coming from the bank of mom and dad or grandma. Bank loans. Banks only care about one thing: the ability to pay back. They may or may not want a personal guarantee, but I guarantee you nearly all of them are going to want a personal guarantee. And yes, they do want collateral. Collateral will not get you the loan. It only secures the loan. They want to see the ability to pay the loan back. So they lend on the ability to pay it back, but they want it secured by collateral. I've had a lot of people say, I've got $1 million worth of collateral, I want $1 million loan. Bank doesn't want to do that because they don't want to own your collateral. They want to see you make your bank payments. Venture capital and angel. Unless there's somebody out there that's got a tech company, venture capital and angel money is going to be very unlikely for you to get. Tech is looking for high risk, high return. And that usually comes with tech. And third-party financing. There's a lot of people out there have money. A lot of people out there are willing to listen to a good business plan with solid financials. The last thing, financing with debt, is a bad idea. And you can replace that word debt with credit cards if you want to. I've got a business right now. He has financed his business by maxing out 44 credit cards. He's not going to be in business very much longer. Your credit score. You have got to understand your credit score and how it works. You can't neglect it. You can get a free credit score every year. Get it, look at it. There are things on that report that frequently don't belong there that you can get pulled off and immediately increase your score. All lenders seriously consider this credit score. Learn how it works. If you go to the mall at Christmas time and you go to 6 department stores and they all say, get our credit card and we'll give you 10% off. If you do that and you get 5 hard credit checks, 5 or 6 hard credit checks in one day, when you leave the mall, your credit score is going to be down 50 or 60 points. Learn how credit scores work. If you have a credit card that's $40,000 and one that's $5,000, and you decide you want to get one of them out of your wallet and cancel it, canceling which one hurts your credit score the worst? Canceling the 40 will hurt your credit score the worst because you've lowered your available credit. It's almost counterintuitive to what you think will work. There is a mountain of information on the internet about how to manage your credit. Learn how to do it. It's very important. And then create business credit separately from your personal credit. So your business should have a credit card, or at least a debit card. And if you get a business bank account, they will give you one based on your balance. Use that to build business credit. When you get a loan, be expected to explain what you're going to use the money for. If you're saying, I want a loan because I need to pay myself a salary, you're not going to get the loan. If you want the loan because you're going to pay off other credit, they'll listen if it frees up capital. For personal expenses, probably not. Increase inventory to speed up shipping. Yeah, that's a good reason to get a loan. Upgrade manufacturing equipment, buy the building. All those things are good reasons for loans. When you approach the lender, you're going to have a business plan. Be prepared to explain how that business plan is going to be accelerated by the money. So I'll put these pictures over here. So the language of business is financial statements. And financial statements, the two primary ones are the income statement or the profit and loss statement. They have two names, same document, two different names. Profit and loss statement, income statement, same thing. The profit and loss or revenue or income statement is over a period of time, January 1st to January 1st of next year, March the 1st to June the 1st, July the 1st to December 31st. It's over a period. It shows what the revenues are for that period, what your cost of goods are for that period, what your expenses were, and then what your net income was. You should be looking at this, if you're a small business, at least monthly. As you get bigger, I'd start looking at it weekly. There are some businesses that look at it daily. If you use QuickBooks or one of the other bank softwares or accounting softwares, all you have to do is learn how to press a button and it prints out for you every day. It's automatic, it's easy. And then once a quarter, you should print out this year and the same period the year before and the same period the year before that. Primary reason for that is to be able to go down here and compare these expenses all the way across. So all of a sudden, you see your utilities have gone up. So they're up 3 times over what they were 2 years ago. And you say, well, that doesn't make any sense. So you look into it and find out you have a problem. That you just didn't realize it because you're just paying your bills and doing your business. But by analyzing and researching over 3 years, you start seeing trends and problems. The other document is the balance sheet. It seems like these pictures keep getting in the way. Okay, a balance sheet is different. This is revenue minus expense equals net income. Revenue minus expense equals net income. The balance sheet is assets minus liabilities is owner's equity. You notice over here under assets, it doesn't say anything about revenue. Over here, it doesn't talk about expenses, it talks about liabilities. There's a difference. And you need to read these two documents together. For example, back over here, we have rent, okay? That's on the income statement, that's on the profit and loss. Over here, we have land, buildings, equipment. Rent's not over here. So rent wouldn't show. But if I'm buying the building and leasing it, I'm buying it for myself, it's over here. The payment for the building's over here. So like on the last one, it showed no rent. That's because over here, he's buying the building. So when you look at the income statement, go, oh, look at me, look at all the income I've got. Well, but your rent's not subtracted from it because your rent's over here. You got to be able to look both places and understand what's going on. If you're buying the building, that's not rent, that's a liability. So you got assets, so your revenue is an asset till it's cash in the bank. So you got your assets up here, your cash, your inventory, things like that. You've got your other assets, your long-term assets like property. And assets and liabilities and owner's equity have to match. That's why it's called a balance sheet. These two numbers have to match. And a balance sheet is on a period of time. It's not over a period of time. It's at a period of time. It's as of January 1st. That's it. July 1st, boom, that's it. It's as of that date. And it has to balance. Its asset minus liabilities is owner's equity. This is what you own. There are some other financial statements like cash flow statement. Cash is king. Without cash, you don't have a business, you're gone. You've got to learn how to control cash. So what are your sources of cash? How do you use them? What's been your change in cash? That's your cash flow statement. So receivables. How often do you look at your receivables and how often do you look at your aging? So I had an air conditioning business come in. She knew she wasn't going to be able to make payroll in 2 Fridays. She needed a $10,000 loan. And she had her computer with her, so we pulled up her accounts receivable. There was $49,000 owed her. Then we pulled up her aging report. How many of you know what your aging report is? It tells you how long people have owed you money. The majority of her money had been owed to her for over 30 days. Some of it went out over 180 days that people owed her money. She didn't charge interest, she didn't collect, she didn't call people up. So we had a very frank eye-to-eye discussion, and I sent her back to get on the phone and start calling people. I said, I'm going to tell you what they're going to say. 100% of the time, they're going to say, I never got a bill. And I want you to be sitting at your computer, and when they say, I never got a bill, I want you to go, click, I just said it. She came the next week, and she collected $39,000 of the $49,000, including the money that was over 180 days old. All she had to do was call them up and ask for her money and send them the bill. You need to be doing the same thing. A lot of you don't call and don't follow up on people. The biggest reason is you think you're going to lose them as a customer. Well, I'm here to tell you, if you've got an air conditioning business or carpet cleaning business or something like that, and you'll come over to my house and you'll do work for me and not ever bill me, let me know, because I'll sign right up. So do you know how to look at your financial statements? All you got to do is press a button to get them. Can you get to them without asking your accountant for help? You should be looking at least monthly. How many years do you go back? I said you should go back and compare 3. Do you follow the stories like your aging report? Got to look at that aging report. So next business plan, or next secret of success. You got to have a business plan. Got to. McDonald's has a business plan. Apple has a business plan. There is no major corporation out there that doesn't have a whole department of business planners. Any successful business plans, if you did a plan to start with, and that was 3 years ago, it's changed by now. You've changed, your business has changed. Your business plan should always evolve with you. Go back and look at it and keep working that business plan. Every 6 months, you should be sticking your nose in it. So I mentioned McDonald's. McDonald's gets its eggs from a company called Cargill. Cargill's the biggest food company in the world. To go to all-day breakfast, McDonald's needed 6 million more eggs. Cargill, being the biggest food company in the world, can't even come up with 6 million more eggs on short notice. That took 3 years, which means McDonald's had planned all-day breakfast 3 years before they ever announced it and did it. They planned. All these companies plan. As they're talking about the new Apple iPhone right now, I'll bet you Apple has plans at least for 2 more generations of phones already on the books. The plan's already out there. There should be a sales plan and a marketing plan. Sales and marketing are not the same thing. Sales is a function of marketing. Don't get them mixed up. You should have a production plan. You should forecast. How do you know you got a problem if you're not forecasting. I used to keep a whiteboard beside my desk. I kept every deal I was working on that whiteboard. And I had it separated in 30, 60, and 90 days. I could look at the 30 days real quickly and tell if I was going to make quota that month or not. If I wasn't, I was going to move stuff up I had moved stuff up from the 60 day and get to working on that. But our company was really, really strict on forecasting because we didn't want to inventory a bunch of stuff. The more accurate I could be with telling the factory what I was going to sell when, the more accurate they could be at producing stuff when I needed it. And it kept our costs down, which kept our pricing down. Forecasting is extremely important. Financing plan. How are you going to finance this stuff when you do it? So if you got a business plan, a production plan that's pretty aggressive, don't you need a finance plan to go with it? And your project engineering plan, what's that look like? One of the best pieces of advice I ever got was from a CEO who was an engineer, and he was grooming me to take over his spot as CEO. And we were on a midnight flight one time, and he said, I'm going to give you a piece of advice that you're going to find strange coming from an engineer. He said, there comes a time in a product's life cycle, development cycle, when you have to shoot the engineers or shoot the programmers and go to market, because they are never, ever done. Think about that. So I was talking about Apple. You know, at some point when they're developing a new product, they got to say, okay, that phone we want with the flex screen, that would be nice to have, but we haven't put out a new phone for a year now. So let's put out that new phone now, and we'll save the flex screen for next year. That'll be version 2. So your product engineering plan needs to be the same way. When is a product ready for sale? When can you go monetize it now? Or are you just going to keep dragging it out and pour more expense into it, not making any money from it, and giving the competition a chance to catch up? Or get further ahead, which is worse. What's your product engineering plan? Do you know? So back to Shark Tank, Robert Herjavec says, money does not grow companies, it accelerates business plans. Think about that. Money doesn't grow companies, it accelerates business plans. If you plan to use that money, you can accelerate. If there's no plan, a lot of it gets to be pretty worthless spending. So let's talk about cost of goods. This is something a lot of you are good at, and a lot of you aren't so good at. When's the last time you looked at this? Do you know what your cost of goods are? Because it directly affects your pricing, and that directly affects your profit. How do you know your pricing is right? I recently looked at a floral business, and the floral business was 66% cost of goods. That meant they only had 34% to pay in labor, utilities, overhead, everything. They couldn't control their cost of goods, 66%. They were out of business. They were bankrupt. So when's the last time you took 50 invoices and costed them out? So if you have an air conditioning business, for example, when's the last time you took a weekend, pulled 50 invoices from the last 50 jobs you did, sit down with pencil and calculator and costed them all out to see how your pricing and your costs came out with your profits? A lot of times costs sneak up and you just haven't paid attention because you've been too busy getting the job done. There comes a time when you as a technician have to step back from the business and start working on the business rather than in the business. And if necessary, you have to make an appointment with yourself in your appointment book. 2 hours a week, I'm going to work on my business, not in my business. and be very strict about that. Do you have all of your overhead included? People make a big mistake not getting this done. Do you know where your marginal costs are and where you can add more production at no costs? So we had customer service representatives that we knew could handle 200 accounts on their desk. Once we had to hire a new customer service representative, if we gave them 100 accounts, we knew we could add another 100 accounts on their desk without adding any further labor cost. We'd already paid for them with the first 100. So that next 100 was going to be free. That's marginal labor cost. Can you add more without increasing? Your cost of goods should be stable unless volume reduces costs. So if you're buying a certain amount of materials, that should stay pretty stable unless something has happened and your volume has increased to where you can buy more materials and get a decreased cost on them. Labor and machine costs will fall with volume. Utilities will fall or not be a factor with volume. So do you know your metrics? Do you know the metrics for your industry? So restaurant metrics are very, very clear. They need to be 33% cost of goods, 35% labor. Those two together are called prime. A good restaurateur holds his prime to 60% because everything above that has to be overhead. That's why restaurants operate on such terribly thin margins, because they've got to control that prime because they've only got 40% on top for all their other expenses. You've got to be very, very careful about that. The information on what your metrics are probably online. You can probably find them. You can find them at trade shows. You can find them in trade magazines. Get involved in your industry. Talk to competitors. If you've got an air conditioning business on one side of town, I guarantee you an air conditioning business on the other side of town will talk to you because you're not competitors. There are people in your business that will talk to you. Ask them about their business. Get their metrics. Compare yours. Things like how many touches does it take to get a deal? I knew with my sales force, it took 7 touches. Whether it's emails, phone calls, visits. I knew it took at least 7 touches where we were going to get a deal. I knew my metrics to the point where a sales guy would come in and say, Steve, I want a raise. And say, well, let's look at this. Out of every 10 phone calls you make, you get an appointment. Out of every 3 appointments, you get 2 proposals. Out of every 2 proposals, you get 1 deal. So if you make just 1 more phone call a day, at the end of the year, it's going to result in this many more deals. And that's more than the raise you're asking for. Just make 1 more phone call a day. Know your metrics. So the Kelvin temperature scale that we all work on, invented by a guy named Lord Kelvin, but he also said, if you can measure what you're speaking about and express it in numbers, you know something about it. If you can't express it in numbers, your knowledge is of a meager and unsatisfactory kind. It may be the beginning of knowledge, but you have scarcely in your thoughts advanced to the stage of science. So I'm ready for any questions if there are some.
All right, everybody, yeah, please list up your questions in the chat box or on the Q&A, and we got a few minutes left. We can have Steve answer some questions.
If you'd like some score mentoring, if you're in Phoenix, here's who you contact. If you're looking at us from Southern Arizona or Northern Arizona, you're saying get in contact and get a score mentor of your very own. Like I said, we're free. We're glad to help.
You know, Steve, you mentioned business metrics and for industry. APS has a new tool that they're launching, and they're going to launch it with us on our boot camp next Tuesday on the 10th. So I encourage everybody to sign up. It's an awesome new tool for data metrics that is free to everyone, all businesses in Arizona. It's designed to help small businesses have the industry data resources that big businesses use to help gain their competitive advantages. So next Tuesday at 9 a.m., I'm sorry, on the 10th, so next Thursday at 9 a.m., a week from Thursday at 9 a.m., September 10th will be that session. So we have 2 questions in the Q&A. Rogelio asks, what is your take on utilizing online sources to conduct credit reports on your company?
Online sources to
Using online sources to conduct credit reports on you and your company.
get your own credit reports?
That's what I would take it to be, yes.
Yeah, you're allowed to get 3 free credit reports a year, or 1 free credit report a year. And that credit report comes from all 3 of the services, and it's free. So you shouldn't be paying for one. Everybody's allowed 1 free report a year.
Excellent. That answered both the questions we had up there from different people. So, well, we're getting close on that time. We want to thank Steve for being here with us today. This session is being recorded, and we will have this slide deck as well. These tools and resources will be available on our Small Business Bootcamp website. So you'll be able to check them out later today. We do have one last question. It's a good question, so I want to review it real quick. It says, do you have mentor inventors? I have several working prototypes that I need to sell outright. So Steve, you guys work with inventors on?
Yeah, and I've done that. That's, and I'm glad you want to sell them outright or license them. The people who want to go into production, that's really hard. So yeah, we work with a lot of inventors.
So excellent. So if you're an inventor, you can reach out to SCORE and work with them as well. So again, everybody, thank you for your time today. We appreciate you being on the boot camp. We look forward to seeing you again on Thursday, 9 a.m. We want to thank Steve for sharing this presentation today. And everybody have a great day and a great week. And we'll see you on Thursday. Thank you.
Go out and make a profit.